Mahindra Mutual Fund. Today we are launching a new fund scheme which is Mahindra Credit Risk Yojana. This fund will invest in corporate bonds, and from this bond fund we will try to give investors a return which is slightly better than the deposit rates that they get. The additional advantage is that you also get the benefit of long-term capital gains tax if you stay invested for 3 years or more. Given the volatility in the equity markets, this kind of fund is highly advisable to those investors who are looking for reasonable safety, good liquidity and a decent return. Thank you.
So உங்களுக்கு மட்டும் தான் சேஃப்னு சொல்றீங்களா?
See, the safety is relatively higher than equities. Certainly, it is a bond fund, and then investing in bonds issued by corporates. To that extent, in debt market, the safety levels are higher than the equity markets. Trading calls, and by trading a little bit, you make some extra money. So there are 4 sources from which this fund will make money. Of course, the first 2 are the most important: interest accruals and the capital gains. And therefore, in doing so, it will target a return, according to us, which will be little over the fixed volume. The deposit rates today in the market, all the way from the banks to the NBFCs, they range somewhere in the space of 7.5 to almost 8.5 or there. That's the range. We will be hoping to give slightly better than that. It is difficult to say how much, but the idea is try and improve on that. And that is the reason why people should look at investing in this. To give you a sense of what has been, so that if you take a combination of all these 4, it reflects in a number called yield to maturity. YTM is what it is called. And that YTM for corporate bonds across the different risk profiles recently has been these numbers. If you look at public sectors, which is 8.6, that's in AAA. In AA, it has gone to 8.9. In this AA to A+, it has gone from all the way from about 9.5 to 10.5. And in A, it has gone beyond 11, almost to 12%. So somewhere in this red box will be our portfolio. Somewhere between 9.5 to 12. If you average it out, you can do the numbers, what the market has given so far. What it might give, we think might change, because rates are actually rising now. And we believe the rates will rise for a little while longer. Because one, there is a lot of credit demand from the market. And when there is credit demand from the market, the price of money will go up. Secondly, we think that there is a negative balance of payment situation that is rising fast on account of oil, which is now tapering off, but more on account of tariffs. The tariff barriers that are being set up very fast across the world. The only way an emerging market economy can respond to it is by devaluing its currency, so that the impact on the corporate and the economies is lower. And if devaluation is going to happen, that always will give rise to higher rates. So some of these factors we see continuing to play over the next one, because rates are rising. This is a good time to get into a credit risk fund, because the returns from here on are likely to rise. And then you also have the advantage of more beneficial taxation. So this, for the next 2 to 3 years, we think this kind of portfolio is likely to make far better returns than the others. Of course, we have a team of fund managers that are experts in analyzing the risk and making the deposits. There is a total of 10 people actually in a fund management team, which look at doing all the investments.